Those who listen to the recording later will be spared. Yes.
I cannot believe that you did not get my Uncle Roy's peanut joke. Charlie Brown. Oh my God. Okay.
Come on. Very disappointing. Yeah, I'm out of here. I'm done. You're not talking jokes. I'm out of here.
Well, listen, I know it's about 6:07, and I want to definitely afford, Uncle Roy and Alan and Brad the opportunity to speak to the community for those who were able to join today. So first of all, welcome to the PEN community. It's always a blessing to be up and be seen or be heard. So we got to be thankful for those type of things that we sometimes take. I don't know. I think we take it for granted sometimes. But getting up, being able to go get your work done, and figure out things, or scale, your business, or understand things that you didn't know anything about before. When it comes to gaining access to capital, or understand what you really need to go into a bank and ask for $500,000 or $1 million or $2 million. There's a lot of things we just need to be thankful for. But nevertheless, I definitely am proud to say that I have my Uncle Roy, I have my nephew Alan Sanders, and Mr. Brad, who's also the adopted nephew. They don't look like me. No, I don't look like them, but they're my relatives. Okay. So, but no, having them today to speak about the importance of capital, the do's and don'ts, and we try to make things, crystal clear. So this is a place where you don't have to be embarrassed about the questions that you ask, because a lot of us are really struggling and trying to understand how do we truly gain access to capital to take our businesses to the next level. And I've always said this: if you're gaining access to capital, that money's only for two things: for your human capital and your equipment. So you got to be prepared with all your docs, all your business plans, your PPMs, your key person insurance policies, your succession plans, a lot of things that we just got to be prepared to be asked that we provide for, these institutions, these banks, these private equity groups, these VC groups, and family offices. So without further ado, I'm going to kick it off with my Uncle Roy, who's also out of Austin, Texas, and he will introduce his team, and then we'll get started on the presentation.
Thank you very much. As always, a pleasure, and always grateful for the opportunities to visit with Rodney and LaRonda and the family and the business and the model that he has built. I've seen a lot of business models, and I've never seen anything like what Rodney has built, and I'm in awe of it. And I'm inspired to live a long time just to watch it unfold and see the difference it's going to make in the lives of so many people. And tangent with that is building community and building family and creating meaningful jobs. I mean, all of that is part and parcel to what Rodney has done. So my advice to anybody on the call who doesn't yet know what PEN is all about: take the time, study it, learn it. I can't imagine any other resource more valuable to you than what Rodney has built. So with that, I will step back a little bit and talk in broad terms about raising capital and kind of the things that you're going to hear about, things that are paths to capital and so forth. And then inside of that, you have 3 of the 4 founding members on the call tonight with Karmic Payback. We're big believers in the positive version of Karmic Payback, not the vengeful side of Karmic Payback. So more the pay it forward kind of strategy. It's a true north for us. We want the investors to do well. We want the company to do well. We're not into a churn and burn model. That is not who we are, not what we're doing. It's one of the reasons we're fairly selective in the companies we take on to help raise capital, because if we don't see a path for success, we're going to offer some coaching and some things you might need to straighten up or clean up or get right. And again, working with Rodney, maybe your PPM needs to be put in place. Maybe your audits aren't ready yet, whatever that might be. Turn back to PEN and get the rest of the boxes checked, and then let's talk again. But we love to coach, we love to teach, we love to share ideas, and we're going to have in-depth conversations with you about why we're doing things. It's not just, well, sign here and we're going to do this and we'll explain to you later why we did that. No, we want you to learn along the way and ask good questions and have a deep understanding. Obviously, you're focused on building your business, but this would be a big step, raising capital. If you raise capital, you're likely going to be giving up a piece of your company, and you need to know how much of your company do you have to give up to raise the capital that you need. One of the things that we love to do in our model is, and we're a subset. There are lots of different ways to raise capital. We're not a venture company. We're not a VC fund. We're not any of those things. We're going to work with private companies, right? Find individual investors, family offices. We do a lot of work, strangely enough, with self-directed IRAs. That's an untapped source of capital. If you don't know what those are, we can spend more time talking about that. But in short, if it's a publicly traded company, then you can use Schwab or Fidelity or any of your traditional brokerage accounts that you can buy Google and sell General Motors and do all that stuff all day long. If it's a private company and you want to use your IRA assets to do that, you can't do that with Schwab or Fidelity. It has to be a self-directed platform or trust company that handles the paperwork. Okay. But let me give you an example. Intrust is one of the self-directed firms we work with. A lot of self-directed firms are normally used for doing commercial real estate projects or fix and flips in real estate, but they're beginning to get educated about there are other things we can do with a self-directed IRA. Intrust has 45,000 clients with $45 billion in assets inside those self-directed IRAs. No one knows about how to tap that market, how to tap that capital and put it to use in investing in private companies. We've done that. We've had a couple of seminars there, and you'd be amazed the number of investors that raised their hand and said, we've only done real estate in the past. Tell us more. We do. Well, how would you like to use a Roth IRA and buy pre-IPO stock for 50 cents? Yes, sir. I'm sorry.
No, you were breaking up a little bit. So just a little housekeeping, if anybody has questions, please, by all means, raise your hand. Rhonda will probably recognize you guys if you need to ask a question. And also, this is also the learning side of things. So if there's something that you don't know, or something that Uncle Roy or Alan or Brad are speaking about, like IRA, you really don't know, that's okay. Raise your hand. Yes. So you might want to explain, what an IRA is for those who may not know. And I'm not saying you don't know, but if you don't know.
Okay. Yeah. Good point. You're right. I should not have assumed that. We're back to Lucy and the butterfly. I assume.
Correct.
How did that IRA get from Brazil? Okay.
Right.
IRA, of course, is individual retirement account. So quite often, think 401k behaves the same way under the tax law. So if you make a contribution to a traditional IRA or to your 401k, you made 100,000 that year, you put 10,000 in a 401k or an IRA, you pay taxes on 90 that year, right? You got a tax deduction, and then it's going to grow with no taxes paid on it. And then someday when you retire and you start taking that money out, it's going to be taxed at whatever the current tax rates are for ordinary income. No capital gains, none of that stuff. One of the things I love to teach is go ahead and convert your IRA now to a Roth, which means you're going to go ahead and pay your taxes now. I know it doesn't feel like it in April when you're paying your taxes, but historically, we have pretty low tax rates right now. So if you assume in the future taxes are going up, take your lumps now, pay your taxes, and then invest in a pre-IPO for 50 cents or $1 a round and watch it go public at $6 or $7 and pay no taxes on that gain now or ever. When you take it out in retirement after you're 59 and a half, and that'll be a couple of decades from now for Rodney, but when you turn 59 and a half, you don't care what the tax rates are, you're not paying them. So if I can teach that to people with self-directed IRAs, flip it to a Roth now, invest in one of these companies on the call tonight, and see all of that gain tax-free. Again, disclaimer, no guarantees that IPOs are going to be higher and blah, 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 all that junk, right? So anyway, I wanted to share a little bit of that with you. A lot of people are going to think on this call, man, I got to be the size of PayPal or Airbnb or something before I can think about going public. No, that's one of the things that we teach, and Brad's going to spend some more time with that a little later. But we show you paths in which you grow into the valuation of the company. Sell off a little piece of your company now for the equity that you need now to grow you to that next level. Don't go after, I need $1 billion raise and I'm going to sell 100 billion shares of stock at 50 cents a share. And yay, I now have $1 billion market cap. And guess what? You have 2% of the company left. You just gave it all away at a low valuation. Please Don't do that. Don't do that. We can show you how to not do that. give up the little bit you need now to grow to that next level. And then when you need more capital, your stock is worth more. You're going to sell a smaller piece at a higher price per share and raise that 300 million you need for the next round. Does that make sense? Okay. So with that, we want to spend a lot of time, because we can talk in broad terms this evening, but that's not going to be specific to your situation. So we'd like to leave a lot of time for Q&A and talk about your individual situation. And my apologies for my ancient cat meowing in the background. I have an 18-year-old cat that's has opinions, and right now paying attention to you instead of her, and that's not acceptable. So with that, I'm going to turn it over to Alan Sanders. He and I have been business partners for 20 odd years. One of the things I love about Alan, he has lots of gifts and skills, but the most important thing are his core values and his heart. And his handshake means everything. He's going to deliver on what he says he's going to do. He always starts with the client's best interest, even if that means, no, we're not a good fit for you, or no, you shouldn't go public, or no, you're not ready for raising capital. Whatever that is, he's going to give you his honest answer, and he's going to work very hard to earn your trust and earn his place as a trusted advisor for you. So with that, I will turn it over to Alan. As I like to say, I'm better looking and funnier, but he's smarter. So, Alan?
Good evening, everybody. Hey, Rodney and Rhonda, et cetera. All the Penn family there. Miss you guys. Got to get up to Dallas sometime. Come see y'all.
Yeah, you do.
Yeah, I will. Absolutely.
Right.
So, all right. So the part that I'm going to take tonight is talking a little bit about the sectors that we tend to work in, but not limiting to that, because I don't want anybody to get the idea that, well, I don't fit in one of those sectors he's talking about, so I just, I'm sunk. No, I mean, we've got a company that we're doing some outside consulting with that is literally it's a burger chain. Believe it or not, based in Indianapolis. They're going to do extremely well on an IPO because they're going to be franchising. They've got a strategic business model. They've got sister companies that they can roll up underneath it. There could be some M&A, mergers and acquisition activity, et cetera. So, but we generally tend to try to help people in certain sectors because those tend to be the ones that investors have an appetite for. All right. Now, again, I don't want you to get discouraged if you don't fit in one of these, if your company doesn't fit in one of these, because we've got all kinds of ways that we can help companies gain access to capital, not through the public markets, but these just tend to be the ones that through a public vehicle tend to work. And I'm going to see if I can share my screen. I'm not always successful with this while I'm on a call on my phone. Let's see here. Let's share. All right. Let me see if I can find my screen now. Can you guys see that?
Yep.
Okay, great. So we do much longer presentations that go into a lot of detail when we're talking to investors, right? So I'm going to take a slide out of our investor deck and talk about this from a company standpoint. All right. The top sector that, a lot of people even already know does very well, tends to do very well in a public setting if it's done right, is technology, right? That involves, just about anything. It can be robotics, it can be AI, it can be all kinds of stuff that's new to this market. The SaaS model, which is a software as a service model, tends to do very well as well because there's high margins that can be created once you create the product, the service, the monthly subscription software program, whatever that is. There's a lot of recurring revenue that gets to be recouped again and again and again and again. So we love that model. And then we have a new one called RAAS, which is robots as a service. Brad's got some companies he's working with that they build these robots. They create a fleet of them, so to speak, and then they lease them out to companies. These robots go in and go do stuff, whatever it is that's in the production line or efficiencies or cleaning things or whatever they do. But the company doesn't have to go to the capital expense of developing the technology, building them, maintaining them, none of that. They just lease them per month. Well, that's a robots as a service model. Usually tends to be monthly or quarterly, or potentially to be annual, but we haven't seen that yet. So that's the first kind of broad categories: technology, software as a service, robots as a service. And we call these the 6 sexy sectors. My wife's an author, so she hates that alliteration. Just sounds cheesy, but we love it. So the next one is going to be infrastructure, but it's not just any old kind of infrastructure, just a normal construction company, that kind of stuff. These are more of the infrastructure projects that are changing and challenging the status quo. We've got a company that we're working with that has a new road-based technology as an example. It's going to drastically change the way roads are built in the United States, in our opinion. It's been approved through lots of different, been studied through lots of independent labs, including Los Alamos National Lab in New Mexico, just all kinds of amazing stuff. So we like infrastructure technologies and infrastructure, plays that change things, that disrupt the current status quo. All right, so that's the second one that we really like a lot. Space is a massively growing sector. There's tons of little startups, believe it or not, that are shooting satellites up into space or partnering with SpaceX and Blue Origin and all these amazing new technologies. We got one company that one of the things they do is they collect trash. Well, wow, you wouldn't think that would be a big business, but it is a huge business in that sector. So space as a general sector, which also includes just aerospace and aviation. We've got another company that's an aviation company, super high-end luxury private jet model. So those always do well. Medical tends to be, okay, well, that sounds, everybody knows medical does well. But what we're also looking for in the medical field are disruptive ways of providing services to the medical sector. We've got a company that is a staffing company. It sounds boring. Oh, that's all they do is just hire people and deploy them into third-party outsourcing, contracts. No, they do it in a very different way. And it's specifically in the mental health care space, which is growing rapidly. A lot more money is being applied there at the state and federal level. So we like that one. Cybersecurity. Brad has a background in this. He was doing cybersecurity before it was called cybersecurity with the Air Force and a bunch of other amazing background items for him in that space. But there's also offshoots from the cybersecurity space that are now becoming like using machine learning and AI and some of that kind of stuff. And that all fits. And then the last one is the green technologies, but these have to be green technologies that are not so far out there and unproven that they're hard to capitalize. We want green technologies. We want ones that have been proven out. They've already got a business model, maybe possibly even already making revenue. That would be great. Those tend to be the ones that we focus on. So from an investor standpoint, these are the ones investors tend to latch onto. They tend to do well if they're positioned correctly. But again, I don't want to throw out the baby with the bathwater and say, well, if you don't fit these, if your company doesn't fit these, then you're going to have a difficult time finding money. Just might not be in the public markets, but there's other avenues. All right, let me unshare my screen now if I can figure out how to do this. There we go. Okay, and then the last part that I was going to cover is we've got a couple things that we do also that are pretty unique for what we're the space that we're in, which is helping companies find capital. We always are trying to find ways that we can create strategic partnerships, increase the revenue of the companies that we're helping, find ways that they can grow themselves through mergers and acquisitions, et cetera. I'll give you a couple of examples. We got a company that Brad brought to us that it's based in Austin, amazing technology where it puts all the different stakeholders in delivering food, which would be the Grubhubs, all those kind of companies, the delivery companies, together with restaurant chains and 7-Elevens and all these other places that want things delivered, and then also with the delivery drivers. And they've got a piece of software, or a huge suite of software actually, that puts all those parties together, and everybody wins and everybody makes more money. So there's no resistance, there's no friction in them getting into the market because everybody makes more money, including delivery, which so they don't displace anybody. So their biggest customer potentially is going to be 7-Eleven because one of the companies they partnered with, called Skipcart, 7-Eleven bought them. Well, eventually they're going to be delivering for all these 7-Elevens. We have another client that we're doing some work with. Their biggest customer is Circle K. They have different softwares than each other. One's a point of sale software. These guys do the delivery and food and other items, logistics side, right? They don't compete with each other. So we've got them talking to each other. One can go into 7-Eleven, the other one can go into Circle K and double the footprint that they can push out there. We got all kinds of other strategic partners that we can use as far as a leverage mechanism. We got a guy named Kerry Kendi who's been doing this 30 years. We've got attorneys, we've got CPA firms and audit firms and everything imaginable that you possibly could ever need under our umbrella of services that we not only that we do, but we also can outsource for you as well and help you with. Then the last thing that we like to do to distinguish ourselves is the ways we go out and go find investors. We find investors in places that aren't the normal places. We like the self-directed IRAs. We go and do seminars. We go and do a lot of networking. And it's not the same old book of people. So they tend to be hungry for these opportunities that we bring because they have never heard of the fact that they can do a pre-IPO or some sort of LLC investment where they're going to get a huge cash cow per year. So that's it for me. Next is going to be Brad.
Hey guys, Rodney, thanks again for having us to the PIN Network.
Thank you, Brad. Thanks for being here.
It's great to see everyone. Got a function tonight, so apologize for the tie tonight. Usually more informal, but
That's all right.
yeah.
I see you looking sharp, Brad. You're looking sharp, man. Don't worry.
Yeah. Well, I think this is a incredible time in our economy. I know everyone talks bad about the economy right now, but entrepreneurship is the backbone of growing our GDP as a country. And I think it's pretty cool. My hat's off to everyone on this call who's involved in creating businesses for themselves or families and growing our GDP as a country. It matters. So keep up the great work there. My portion of the presentation tonight is pretty short and sweet, but it's the money part. How do we go about raising money for small to mid-sized companies that have a need for growth capital? And that can come typically in the form of three kind of ways. One is you can go out and get a loan from a bank or a family member and do it kind of in a more traditional way. The Small Business Administration has a loan program that, I think, Rodney, you've probably shared a lot of interesting tips and techniques on that. That's a very traditional path and one that requires you to sign your life away, typically with a personal guarantee. And those can be troublesome, but, also needed in certain cases where, you're looking to buy a real property or an asset that can be collateralized as part of that kind of capitalization, part of the play. The other way is to do either venture capital or private equity. And people talk about these kinds of mechanisms very loosely. They are very different. The venture community, typically, those are funds that have been pooled by high net worth individuals or what they call family offices. And they direct into an investment thesis, typically looking for a very rewarding payback at some point in 7 to 10 years. These are the high-tech bets that people place, and they typically are looking for 1 out of 10 bets to pay dividends to the point where they get 20 to 40 times return on the money they put in. So it's very high risk, high reward is typically the nature of those things. Now, given that, they typically come in different tranches. They call it Series A, B, C, D, and beyond. Don't get too caught up in what those tranches mean, but it's a staged approach at capital. Typically, the venture capitalist is going to eat away at the equity of the founding owners of that company. And again, the big risk reward trade-off for the founding entrepreneurs that go down the venture path is typically to come along for the ride, and they'll bring in venture capitalists that are aligned to their business objective and ultimately to a strategic sale or a go public offering where they can cash out billions of dollars and they take a fractional part ownership of that at that exit. The private equity space is pretty interesting. It's typically for small to mid-sized businesses that, let's just say have 25 to 30 million in annual reoccurring revenues. They've grown substantially, double-digit kind of net income. And that private equity outfit, they're typically coming in with the idea to take majority control and interest away from the founding team. These are going to be more traditional companies that are looking for an exit, that are really good candidates for private equity buyers to come in. There's a number of those types of outfits that range from doing deals in the small to mid-sized space all the way up to multi-billion-dollar private equity houses in New York. So that's, two different styles of venture capital, private equity built for two different purposes. And then one financing mechanism I'll just kind of highlight tonight that we like is a go public option. And what that basically means is it's not necessarily debt, and it's definitely not venture capital. It's a mechanism by which we raise early monies with the intent to take a company to the public markets under a micro cap. And typically that micro cap, this is normally a company, again, doing $20 to $30 million top line, throwing off anywhere from 3 to 5 million in net income. And you put a public market multiple on that, let's say at 20 times, to get a $100 million market capitalization, which is what it trades at, either on the NASDAQ or what they call over the counter. These are just ways by which public stock can be traded. And the benefit of this for an entrepreneur is, number one, you can de-risk by going public. You've basically had to install systems and structures to mature your company to be a viable going concern. And that's a benefit going through the process where you've got to, demonstrate to the Securities and Exchange Commission that you have good accounting practices. You've been through an audit. You've basically followed the process, what they call an S1 filing, which demonstrates to the Securities and Exchange Commission that you're a viable going concern and that you're worthy of public investment, retail investment into that company. And so it does create a higher standard, but it allows the entrepreneur to basically de-risk, have a tradable security on an exchange like the NASDAQ, so you can get liquid over time. And then you have access to institutional investors for growth capital going forward, both debt and equity for follow-on raises. So it creates a really cool dynamic. We like those kinds of deals. We like companies that fit that box. It's not the only path. Like I said, venture capital is right for some companies, private equity for others. The go public approach is something that we like. And then obviously, the founding owner, entrepreneur, if they want more of a lifestyle company, debt, bank, traditional bank financing may be the best path. So those are just some options that we like to deal with. We take a very hands-on, white glove approach to working with entrepreneurial founding teams that are considering their options. And one of the biggest things, the biggest takeaway I just want everyone on this call to lean in on is a lot of entrepreneurs are spending so much time in their business that they don't step out and work on their business and think about what do they really want out of their business. Because you put blood, sweat, and tears in these things, and there's a lot of risk. And although you desire for that big payday at some point in the future, there's a lot of things that could go wrong. And so attaching yourself to other people that have walked in your shoes, taken that journey, have access to growth capital resources and a second set of eyes and ears to kind of help you understand your business objective, and allowing other people to kind of surround you, to advise you, to consult with you, and walk with you in that journey, I think is very fulfilling, and it's very important. And so with that, that's all I have for tonight. Again, I'll make myself available. Rodney knows how to get in touch with Roy, myself, or Alan, and we're just here to be here and help and see where this goes tonight. So that's all.
Hey, Brad, this is Alan. One thing that you might chime in on, if you don't mind, is the difference between if you use the go public strategy and it fits, how much more they can retain in ownership structure.
Yeah, and so that I'm glad you brought that up, Alan. What we try to do is structure the go public option in a way that preserves majority control and interest for the founding entrepreneurial team and their investors. And what that allows for is a better rate of return over, let's say, a private equity approach that's going to come in and want to have the majority control and interest and really edge the founding entrepreneurs out, let's just say. So we do try to preserve majority control and interest, and there's different ways that we can do that. Quite simply, it's controlling the majority of stock, for example. There's other approaches through preferred stock, and more exotic ways to do that if the entrepreneur isn't necessarily in the control seat right now. But that's pretty important to us, is that making sure the entrepreneur gets their pound of flesh alongside of all these capitalists. And I think that is a neat feature, and I appreciate you bringing that up, Alan.
Yeah. Thanks, Al. Brad, thank you so much. So if anyone on the call, has any questions, by all means, this would be the opportunity to ask questions. And please, ask any questions that you choose to. Michael Harper, how you doing? I know you up in Milwaukee, so I know you had some questions.
No questions, just sharing some information. I mean, Agglomerate is a really good book in terms of, the concept of early stage IPOs, and, the other piece about retaining equity is extremely important for early stage companies and founders who are anxious to get more capital, but don't realize what they're giving away at those earlier stages of growing a business. So just being able to consider and hear other strategies and other tactics that can be employed to preserve that equity, but continue to grow the business is great to have that shared this evening.
Yes, Michael, and this is really, yes, thank you for sharing that. And yes, that is a conversation we have over and over again, because whatever it is you're doing as an entrepreneur, I think Brad is correct. You're so focused every day working in your business. And a lot of what we're talking about, S1 filings and super voting preferred shares and other jargon, is a foreign language if that's not what you're used to doing. If you're a pharmaceutical company and you don't want me compounding your drugs for you, I wouldn't know what I'm doing, right? but hopefully with what Rodney has done, you have access to experts who do understand and have Rodney's vision and care about what you're doing and preserving what you've built. This is your baby. And having said that, I do want to offer a little coaching on this as you're approaching an investor. Start with every slide that you're doing. How big is the market? What's your plan of attack for getting your share of that market? How are you protecting yourself against competitors? But most importantly, investors are selfish. What's in it for me, right? Every investor you're talking to is going to want to understand, how do I get my money back and a return on my money that interests me? If you get so excited about your technology and so excited about the team you put together and this and that and the other, is that important? Absolutely. But at the end of the day, the investor is going to want to understand on the front end, how do they get out on the back end, and what is that return going to look like? And we can help you in preparing those pitch decks, help you prepare for that conversation, because we know what the investor is looking for. We want to make sure you push the right buttons so that you're getting the yes that you're looking for. Otherwise, you're just wasting your time. Does that make sense?
Right. So yeah, it does. One of the questions was, how do you raise capital if you don't have any capital? And that was one of the questions that just popped up.
And that's a good question. I'll be honest, there are very few companies we work with that are pre-revenue. That's a hard ask, and that's a different path and not really where our focus is. There are options out there for that. Typically comes at a price. And I would let Brad probably address that. He probably has more experience in helping pre-revenue companies get the capital they need to prove their concept. But it does tend to be a catch-22. Man, if I had the capital, I could do this cool thing. And as soon as I do this cool thing, I'll have access to capital. It's a bit like going into the banker. As soon as you can prove you don't need the money, they're happy to loan it to you. Right. So it is daunting. And Brad can touch on that. One of the things that Brad brings to the table that he didn't touch on this evening, I don't know if any of the folks that are on the call tonight would fit in this category or not, but his background, he was an Air Force Academy grad. He has a lot of experience there, and there are what are known as non-dilutive capital. If you're doing something, if you're building a new tank, probably your next door neighbor doesn't need one of those. Hopefully only the military gets those, right? But if you invent a new cybersecurity strategy, well, the military may have use for that, but guess what? 7-Eleven may need that same thing. There may be a private sector use for what you've developed, therefore dual purpose. Therefore, there's capital available through the Defense Department where they are going to grant you money. And understand that grant means you're not paying it back. It's not a loan, it's a grant. And you didn't give up equity to get it. All right. So if you don't mind, I'm going to turn it back over to Brad. If maybe you want to touch on that a little bit. I don't know if anybody on the call tonight, because I won't hush long enough to find out from people that are on the call, but maybe
So
touch on that.
we'll let Brad, you want to expound on it a little bit, and then I'm gonna let Terrell ask his question.
Michael is very good, by the way. I like Michael Harper's questions. Thank you.
I've been knowing Michael for a long time too. He's only 30 also. Brad, did Brad have to drop? Or Brad drop? I believe Brad had dropped. No, he's still on. Terrell, what was your question?
Sure. So really pleased to have this conversation today. I think one of the things that I've been going through a valuation process myself, and raising capital, like you said, which has been an interesting dynamic for me over the years. I'm 22 years in business. I've kind of had several ups and downs, and bought out my business partner, and done several things over the years to try to position the company. As a matter of fact, we're going through a back office transformation now, just to, I've told my team I'd like to have our back office as proficient as ever. I'm telling them world class is what I'm looking for as it relates to our reporting, our analysis, our numbers, understanding our numbers, and being able to report that out. But some of the things that I know I've had to do, and I've been approached by investment in the past. I took over 100% of the company. I actually took the company debt-free 2 years ago, and tried to do some strategic thing to increase our profitability as well as our overall EBITDA, which led to last year 124% increase in revenue, and a really sizable margin, or should I say, an EBITDA increase. But even going through my valuation process, they said, "Hey, you're doing all the right things, sound really good. The vision that I have for the company, I think the challenge is in a service industry. They always seem to, I feel like it's heavily discounted. Again, I don't have the IP of a widget or of some what I would consider to be overly proprietary mechanism, but I am in unique industries, and we've been able to excel kind of our overall market position. So my question is really around service industry raises, versus other type of raises, and where and how do you see, and specifically what model, like you mentioned, loans are out, private equity. For me, I know that they're trying to get rid of me and take the company a different direction. I want to stay involved to kind of mature the vision. And so I've started leaning towards whether it is a family office or private equity, or you mentioned the self-directed IRAs, but that sounds interesting. Or even I've never really considered an early stage IPO, but it's something that's kind of sitting on my mind right now. But I'm really focused around, and my question is around service industry raises. What do you guys see more often than not?
Well, if you don't mind, tell me a bit more about your company. What is, you said you have kind of a niche in there, that yours is a special sector.
Sure.
Help me with
Sure.
that.
So, sure, I'll make it real brief. So at the highest level, we're a full service advertising agency, 4 offices across the country: DC, Dallas, Atlanta is where we're headquartered, in Los Angeles. We've had a unique specialty in the area of film, television, and sports for a very long time. So we've marketed over 300 films, 37 of those being #1 films and 7 Academy films. We diversified several years ago, where we brought in a lot of what I consider to be, harder level industry bases and verticals of biopharmaceuticals, enterprise software. We deal heavily in retail, big box retail. But I think where we've seen tremendous lift over the last 4 years has been in 3 divisions that I created. One being Liquid Soul Politico. So we're deeply involved in political advertising and marketing and media buying. We're one of 3 national agencies that buy at the top level. That would be for Senate, Congress, and presidential races. That from a Black-owned perspective, we have Liquid Soul Studios. So our studio company produces short, long-form, social level content for corporate brands. And then a Liquid Soul Live, we co-own and produce several live events around the country. And really now we're going international. This year, I'm opening 3 international offices in Sao Paulo, Brazil, Johannesburg, South Africa, and Paris, France. So we're extending our reach, and we're working with many international companies that are US based, but doing business in these international markets. So we're growing those particular dynamics of political, entertainment, kind of our industry and brand base that we engage with, the international markets, kind of gives us a unique positioning when you look at the advertising and marketing space of culture.
I love everything you just said. I would love for us to continue this conversation after this call tonight. And a couple of notes I want you to make. One, are you familiar with Gaia? It is a streaming platform for unique content. It's, hi, did the Martians build the pyramids? Okay, it's in a unique space, but the company we're working with is provided a lot of their content. This is a project that Alan Sanders on the call brought to us, but the guy that owns the business, it's Forbidden Knowledge, which sounds like it's going to be adult content, and we're working a little bit on that. But anyway, that is not what is going on here. But the guy that owns it, as much of the content provider for Gaia, is African American and does unique content that is shared on Netflix and other places. We'd love to make that introduction for you. Separate from that, Rodney will tell you that I'm a recovering political addict. I mean, it's a 12-step program, and I just keep backsliding. But I am way left of center in my political views, and that doesn't go well in Texas very often. But I do have some interesting connections there that would love what you're doing on some targeting, marketing, and kind of the demographic approach that you're taking to this. Jot this name down, Sonia Van Meter. She's based in Dallas, and she does political campaigns all over the country and would be very influential in their media buying and all that kind of stuff. So remind me to connect you with her off record at some point. But I think you've defined a niche market. I think I love your approach. I love the way you de-risk it. I love how you're clearly defined. You're right. And a typical service industry, if you said, hi, we're doing, I don't know, janitorial services for commercial buildings. Well, that's, you buy a mop and a bucket and I'm going to compete with you or something, right? And then it's a race to the bottom. Who can provide the mop and the bucket cheaper than the next person? That's not very interesting. It would be hard to raise capital for. What you're doing, it sounds intriguing to me. I would love for us to have a further conversation.
Okay.
So Terrell, I'll make sure you guys get connected.
Okay.
Team.
Fantastic. And then one final note, Michael, sure. I just want to let Michael Harper know that I'm originally from Milwaukee, Wisconsin, a Rufus Bean graduate. Just wanted to throw that in there.
Okay.
See, we all have a lot in common. I'm originally from up north too. I'm originally from Dallas.
Oh. Outstanding. We were a little further north, but outstanding.
So Michael said, distinguish between raising capital and valuations. Understand the use of capital. That was from Michael.
Yes, use of capital is a good one. I'm going to tackle that one, and then maybe Alan or Brad can take the rest of that. I don't want to take over the whole conversation. But use of capital, yes, that is a very important one. As you're shaping your conversation with a potential investor, that's one they're going to want to understand. And if you say, yeah, we just need money because it makes me feel better. No, that's not very compelling. If you say we're working on some R&D and we're going to have some results in 4 years, they will give you a dial tone faster than you can imagine. They're looking for, typically the projects we're working on will see an exit at the outside 18 months, maybe 20, from when we initially take them on, get through your S1 filings, get through your audits. And speaking of audits, those are not your standard banana, the CPA that does your family tax return. The audits for a publicly traded company are a higher standard, which is good for the public, good for the investors, good for you as the company, but it is a higher standard. So use of capital, though, you need to make a very compelling argument. We're going to take this capital and it's going to drive revenue quickly. It is not R&D. It is not other kinds of things that sound like it's going to take 3 years to get there. That's it's an unusual investor that's going to find that compelling. So yes, the use of capital is part of your conversation, and it needs to be shaped around how we're going to use this capital to drive revenue. Okay, we're going to get more revenue faster and hold our margins. All right. With that, market cap.
Okay.
I'm sorry.
Yeah. No. So I think now, you, Alan, or Brad probably need to make everybody understand the valuations of a company.
Okay, I'll take a first stab at that one. We typically, most of the companies that we work with at least, go into a deep dive on financial model. And we've got a guy on the team, Evan Spalding, who was twice nominated as CFO of the year in Austin. He's super uber talented with thinking strategically, not just in terms of bean counting and the number side. It's more how do all the parts and pieces fit, and where is, by using his financial modeling, we can figure out a lot of times in some surprising ways to CEOs as well, and people that are running these companies. Wow, we didn't know that injecting capital into whatever that channel is that he figures out through his financial model was going to be so effective. So we have a company we're taking up public in April, and when we created the financial model for them, they've been going along and just running on the treadmill, and they're doing a great job. They're growing like a weed. But when he put this financial model together, they discovered that there were some very specific ways that they could use some of the IPO capital after they go public that is going to launch the company into a completely different valuation that weren't necessarily the ways they were already thinking. So you have to have a tool, is the point. You can't just wing it. There's got to be some kind of metric that you're weighing the use of the capital or the deployment of resources against. It's got to be either a valuation metric that is, okay, 20x for this industry of EBITDA is what it should trade for, blah, blah, blah. There's all kinds of stuff. But financial modeling, and it to us, is the quickest way to get there. And then you can back into 3 to 5 year forecasts and figure out, what is the company worth even today? Not just book value. What is it actually valued at based on a trading potential value? So I hope that answers the question. That was probably a lot of information, but.
Well, and let me take one further step on that. Understand, from the investor's standpoint, they're well served driving the valuation of your company down, right? The smaller the valuation, the more valuable their investment is. It's a bigger piece of a smaller pie. If they drive down the valuation, the pie is smaller, right? So the financial modeling that Alan is talking about, if I did a spreadsheet, it's sort of like playing chopsticks. When Evan does a financial modeling software package, it's Mozart. And what that allows us to do, if we're working with you in developing that model, then when we're talking to an investor, if you don't have a deep understanding and able to defend the valuation that you're putting on your company, they're going to rip you to shreds and beat you up and pummel it down. And you're, after a while, going, well, maybe they're right. Maybe my company's only worth $5,000. I don't know. Man, that was rough. If you've gone through this financial modeling, you go into that conversation strong, and the investor understands why you're valuing it that way. And if their only appetite is how to beat you up, then we're going to say next, and we're going to find a different investor. That's not the one we're looking for. But we want a financial model that defends your valuation and can, if they want to challenge the assumption and say, oh, well, what if you only did X? His financial model, you just plug and play. It cascades throughout the model and changes everything. What other assumptions do you want to? But by the time we're having that conversations, we're prepared to defend every assumption in that model, and therefore the valuation of the company. Does that make sense?
Yep.
Okay. What you can't do, we had one company, one more comment. We had one company that's going to end up with a huge infant neurological database, and it'll be unique on planet Earth, and it will someday have a lot of valuation. But day one, he wanted to say, look at the valuation for Ancestry.com. Well, yeah, they've got a long history and got a lot of data and big data, and they get to defend their $1 billion valuation. You ain't there yet, buddy. You can't defend a $1 billion valuation when you don't have your first infant. I'm sorry. So, as Rodney likes to say, sometimes you're going to have a tough love conversation or a love letter with Uncle Roy that'll say, yeah, but.
Yeah, we've had those conversations before with that individual.
Well, but the good news is he's there now, because he revamped his short-term business model so that he's going to get there, and it doesn't matter what that other stuff is. That's all going to be gravy on top. His short-term business model is so strong. That was the cool thing about that. Hey, I wanted to add one thing on before I forget about it, guys, because Roy brought up something earlier about how you pitch investors. We coach people. I'm going to give you $1 million tip here that we didn't invent, that we learned from other people. You start your pitch deck telling the investors exactly what the deal is. Don't start talking about your company. Don't start talking about the leadership. Don't start talking about your services and your technology and all that. Literally, we coach people that the very first slide should say, here is what you get as an investor. You put in this amount. We're valuing the company at this amount. We have these projections over the next 3 to 5 years. Here's going to be your exit. Here's what you get. And when they see all that and it sounds compelling, now they'll listen to all the rest of your deck. But if you start out with a bunch of data and information, they're sitting there going, okay, I understand I got to hear all this, but I'm really only waiting for what's in it for me. If you start with that, it really helps drive the rest of the conversation. And their patience, if they hear a very compelling offer right out the gate, it's like, whoa, okay, this only has a 90-day, lockup period after the IPO. That's unique. Something like that. If you catch their attention right out the gate, they're going, what? This has an LLC. This is an LLC that's going to throw off 9 times my investment potentially in the next 5 years. And here's how we can back up that. I mean, that catches their attention. They're going to listen to the rest of your pitch. You got to start with what's in it for them. That's my 2 cents and my soapbox for the evening.
No. So a question was, can you raise money for a franchise?
That I'll take that one. I've never done that. I don't know how you make a compelling argument around that. If you're not the parent company with the intellectual property and all that kind of stuff, you may not be controlling all the variables that an investor would want to see. Having said that, I've now told you more than I actually know. I have never raised capital for a franchise. I'm sure there are people out there that do that. It's just out of my experience. Brad, do you have any thoughts or insights on that?
I think Brad had to go. We had a dinner to go to.
He had, yeah, I think he was. As a matter of fact, he's in California with Alex meeting with an aerospace project that we may be raising capital for. But my apologies. No, I do not know how to raise money for a franchise, but clearly money gets raised for franchise. So somebody knows how to do that. It's just not me.
That, to me, I think that falls back to a friends and family raise. Usually in most cases, you just go out and raise it through your own network. That's the way a lot of seed capital is going to be raised. There may be some angels, there may be some people that have an appetite for helping franchises get started, but that's going to be difficult.
Or if you already have franchises and are positive and you're looking to expand into additional markets, that may be a bank deal or an SBA deal. But there's Michael always has an answer. I don't know why.
He does.
I have no idea why Rodney even had us on the call tonight. He just needed Michael. Come on. Michael, we got to meet and have a cup of coffee, man. I love everything you're doing.
Michael will be in Dallas sometime soon because he owes a trip down too.
Yeah, let me know I'm in Austin. I'd love to run up to Dallas and say hi.
Okay. Does anybody else have any questions? Good to see you, Damon. Anybody have any questions? Don't be bashful now, please. By all means, don't be bashful by asking questions.
Yep, absolutely.
Lamont, I see you here again today. Hey, DJ, how you doing?
If there, or while you're waiting for another question, let me share another little bit about approaching the investor. Assume for a moment that you're cybersecurity, and I understand S1 filings and how to raise capital and how to structure a pitch deck and all that kind of stuff. I have no idea how to do cybersecurity. We're going to have subject matter experts we can turn to and that sort of thing, perhaps. But pretend I'm the potential investor in your deal. Dumb it down. Put it on a 5th grade level, use small words. If you use a bunch of jargon that is a foreign language to me, I'm just going to go, I don't think I understand this well enough to feel comfortable investing in it. So keep it simple, keep the concept simple, keep your path to the market simple, all that stuff. If you want to throw up some text slides and show some cool stuff, fine, but I would skip through those quickly. It gives the impression, lets the investor know, you know what you're doing. So they don't have to worry about that part of it. But you didn't spend 10 minutes on a slide that I simply do not understand because I don't understand the jargon of the technology or whatever it is. Show me what's in it for me. And what's in it for me is you have some cool technology, you have some intellectual property around that, you have a great business model, you have a margin, and you're planning to go public in 18 months, and I should expect a 5x return. Tell me more. All right. And if they want to take a deeper dive, maybe they have a subject matter expert and they'll geek out with each other. Their subject matter expert will talk to you or your engineer and or whatever. But again, keep the story simple, easy to follow, and avoid jargon when possible. All right.
Anybody with any questions? Alan, you have anything that you want to leave the team, the family here today?
Alan, you want to take it? It seems like I'm answering all the questions. You want to take that one?
Yeah.
Oh,
So
Damon,
financial statement.
Hold up. You saw that, Alan, the question that Damon
Yeah.
had?
Mhm.
Okay.
Financial statements and a pitch deck. Yeah. We don't recommend full financial statements in the pitch deck. That's going to make people's eyes glaze over. You want to offer a conversation about the deeper dive into the financials as a second offering. The pitch deck, in my opinion, needs to be high level overview of what's in it for them. You can say, hey, we've got a very deep dive financial model second conversation we can do for you guys. That's my opinion. Be careful about getting into too much detail on the pitch deck. So going back to Roy's point as well, you know, this fits in that same thing, which is, you know, how much information, right? Tell stories. Tell people stories about how you have helped clients. Don't talk about it's like telling people how the watch is made versus look at this cool watch. This watch, people, you know, all my friends love this watch, and all my everybody that I've ever shown this watch wants to buy it, and here's why, because look how cool it looks. They don't care how it works, right? So if you start going into the detail about how your product works or service and all that other stuff, again, their eyes are going to glaze over. They might love you, but the best thing to do is say, let me tell you some ways that we've helped people. Here are 3 companies that we worked with last year that we affected their bottom line this way. We slowed down the cybersecurity attacks by this much, blah, blah, blah. Tell them those types of simple details. You're not going to insult them by just keeping it simple. They actually like that.
And let them know that there's detail behind it, but the purpose of the pitch deck is to intrigue them, to get them interested. So they want that second meeting. So they want to take a deeper dive. So they want to ask more questions. It's not to do War and Peace on the first meeting. And we're now up to page 879. Let me read this one to you. No, don't do that. Okay. Pique their interest. Let them know that you know what you're doing, but save those deep dive conversations for follow-up conversations. If that makes sense.
Looks like there's another question about franchising.
Yeah.
Says my question should have been, I need to raise capital to join a franchise business.
Okay, so to get your first one, is that if I'm following correctly, you want to buy a franchise, get started. To me, that sounds like personal guarantees and SBA loan. And if you've got a track record and a great credit score, beyond that, it would have to be friends and family that believe you found the right franchise and they know how hard you're going to work to make that successful. The investors.
You know, the one thing I would add to that, though, Uncle Roy and Alan, you know, and we've actually seen this ourselves, like even when you're going for debt capital, right, and you may have a great credit score, and we just had Chase on last week for all of those who wasn't on the call last week, and we'll have series of financial meetings like this every Tuesday. But for the experience we've actually seen personally, if you have a great credit score and you go into the bank, whether it's Chase, Wells, B of A, Truist, or what have you, Fifth Third Bank, the big box banks, it doesn't matter. If you don't have recurring deposits that goes in your account like every month, whether it's 5,000, 10,000, 20,000, every single month, chances are you would not get that line of credit or that loan.
I agree.
So I just want to make sure that, you know, you're totally aware that does happen. You're like, man, I got a 750 score. I'm asking for $500,000, or I'm asking for $1 million. And last week, and some of you guys can go back and see the meeting last week, Chase is offering up with no financial docs, $250,000 to $500,000 to come into his bank and get a loan or a line of credit, right? But if you don't have the credit and some recurring deposits, even with no financial docs, you still might not get that loan.
Well, and I can't imagine you finding 100% loan. They're going to expect a lot of your skin in the game.
Yeah. Yeah,
And think
yeah.
of it from Chase's
Well-
standpoint. Let's say it's a franchise, then you're making widgets and it doesn't work out. Now Chase Bank has a franchise making widgets. They're like, what the heck do we do with this? They don't want to be in the business of running a franchise and making widgets. That's not what they do.
Yeah,
So
right. And they're not your equity partner, they're your debt partner. You got to pay that money back, but they want to know that you got skin in the game. It's true. So you got to have recurring deposit. If anything else, there's some tricks to the trade, which I won't talk about tonight, but you got to have reoccurring deposit. That is for absolute sure. And we know that firsthand now, for sure. We do. Seriously.
Well, I have a quick comment, Rodney. One quick
Yeah.
comment on the franchise thing,
Sure.
because I mean, a lot of if it's a good franchise model, a lot of times the parent company that's offering the franchise opportunities will have financing. So that maybe like an
Yeah,
owner
correct.
finance
That's true.
scenario, and
That is
or
true.
they will give you ideas. They've got lending and different things all lined up, and SBA loans that they know that they can get approved, especially if you got some kind of, location that you're putting the thing in that can be collateralized in some way. Maybe there's a owner finance or a leaseback type option or something like that on that.
Right.
But you also then, if you can find all those little pieces and then there's a little bit left over that you got to come out of pocket on, that's where you can get friends and family involved. So let's say it's a $100,000 franchise and you got to come up with 30% down. Well, that's only 30 grand. If you go out and talk to enough people and sell them on your idea and learn how to put together a pitch, then you can sell friends and family and go raise 3,000 from 10 people. And now you got your investors. No, nothing wrong with that. That's just part of your deal.
and this is a recorded call, and I'm going to go ahead and say this out loud. I hope it's not a subway you're planning to get. That's a bad model.
What was that, Uncle Roy?
I said, I hope it's not a subway you're planning to get. That's a bad model.
Well, listen, because of the time, and I know it's Tuesday evening, we don't want to hold everybody who has families and been working all day and everything else, but I don't know if anybody else had any questions. I don't see any hands raised.
I have a question though. I'm sorry.
Okay,
I
LaRonda.
hate to. Anyone who's on the call whose name is not up here, I know I see a couple of iPhones and things like that. Can you put your name, company name, and email address in the chat so that all communication can be sent to you, and that we can continue to keep in contact with you, please? I'm done. Sorry.
Okay.
Rodney, I've got a blanket piece of resource that I would like to offer out to the group, which is there's a guy that we've been working actually directly with his company, but he does some amazing stuff that's very affordable. There's a lot of free stuff on his website. His name is Oren,
Okay.
O-R-E-N, Klaff, K-L-A-F-F. He wrote a book called Pitch Anything. He's got all kinds of courses you can sign up for short term. You can do them for 30 days, 60 days, a year, all kinds of stuff. And it's coaching on how you as an entrepreneur need to go out and go raise money. He's got pitch deck examples. We use a lot of his examples, again, starting with the end in mind. He's got pitch deck examples that say, you as an investor are going to get this, this, and this. And he gets right to the point, and he does. So that's a great, in my opinion, I don't get anything from that guy for pitching him, but his stuff is amazing. And he wrote another book recently. I forgot what it's called, but it's the second book after Pitch Anything, but they got a lot of really cool, very affordable stuff for entrepreneurs.
Flip the
I
script.
think we should definitely bring him into the PN community to pitch, because this it's getting bigger and bigger, right? To pitch to all these entrepreneurs, because I think everybody needs, some type of coaching like that, right? And I know we'll have a lot of subject matter experts coming in, every week, every Tuesday. And also being in the community, you can go and visit with any subject matter expert in the community anyway. But we probably should, Alan, get him in at some point, to the community.
Sounds great. Flip the script. Yeah, Roy said it. Flip the script is his second book. Pitch Anything and Flip the Script. And then go to his website. You can sign up for his newsletter and attend he does little webinars and different things all the time. Yeah, I love what he does, what he teaches.
Okay.
It's great, right to the point, affordable stuff. All right.
And
Well,
Rodney, let me predict,
sir.
you're about to start the second half of your day, right?
You're right. About ready to start the second half and sleep an hour and a half and get up at 4:30 and go do it again.
Well, thank you again for inviting us. I hope y'all found something useful out of this.
No. Thank you, guys. Thank you, Uncle Roy, so much. Thank you, Alan and Brad. I know Brad's already gone. He's up in New York. You say he's in New York with Alex? He's up there with
No,
Alex
San
in New York?
Francisco.
Oh,
They're in San
Fran.
Francisco.
Okay, I got you.
Yeah.
But no, thank you guys so much. I mean, you guys have been part of the family for a long, long time, you know, and it's always an honor to have you guys here. For everybody on the call, you know, these are probably the realest guys you're gonna meet. You know, I know everybody got their real friends, real uncles, real nephews, but these are some really, really good guys who really trying to help, you know, all of us scale and grow to another level, because it's a challenge. It's a challenge as a small business trying to, you know, really understand how to gain access, or even if you understand it, it's still tough to gain access to capital. That's just the truth. So, you know, with that being said, 7:10, I want to make sure everybody has a good night, but make sure you get your butts up in the morning and go get it again. Keep scaling, keep getting up. Make sure you take care of your body too now. You got to take care of your body, because your body's not going to get up and take care of you. So you got to get up and take care of your bodies too, so that you can continue to take care of this business. But I want everybody to have a good night. And again, Uncle Roy, thank you and Alan and Brad so much for being on the pen call this Tuesday night. Anybody else got anything to say? Wow, this is a good group. They don't say anything. Terrell, all right, thanks.
No,
All right, guys.
Yeah,
Okay.
this was
Ladies,
wonderful. Thank you
have a
all. I
good
really
night.
appreciate tonight.
Thank you.
Good night, guys.
Take care.
Take care.
Have a
All
good
right.
night.
Thank you.
Have a good
All right,
one.
take care.
Bye-bye.
All right, bye-bye.
Bye-bye.